Hi everyone, my name's Yash, and welcome to this YouTube channel where we hope to uncover some of the key jargons that you hear in the financial market space and hopefully remove some of the intrigue behind key terms that you keep hearing from time to time in the financial market space. And one such phrase is the presentation that we're covering today, which is the yield curve. You might have seen this phrase pop up in the news recently with investors freaking out about the inverted yield curve and how it's supposed to signal a recession. But let's take a step back and understand what exactly the yield curve is, how it functions, and how you could potentially use it to foresee what might be coming up in the economy in the near future. So let's get started. To understand the yield curve, we first of all need to understand the fundamentals behind how an investor behaves and the sort of returns that he or she would expect when they go ahead and make some sort of investment. So let's say we have an investor in front of us, represented by the blue icon. And let's say they have a lump sum of money that they're looking to invest. The typical way that the investor would invest is to access the financial markets. And in this case, we will represent the financial markets with the orange institution. Let's say for this example, the financial markets institution is a bank, and the investor is effectively looking to invest in some sort of term deposit with the bank. So the investor will be looking to invest the money into the bank, and in return will be expecting some sort of return, literally. So we mentioned that the investor will be looking in term deposits, and say the duration of these term deposits could be 1 year through to 3 years. I had a quick look at interest.co.nz to understand what the average rate for a term deposit could look like for term deposits in New Zealand, and I got the following rates. So a 1 year term deposit could be yielding a return of 2.95%, a 2 year could give you a return of 3%, or a 3 year could give you a return of 3.05%. We can see that an investor could potentially create a table of various term deposits maturing in different time frames and the corresponding returns across them. So we can check that the 3 month term deposit gives you 2.25%, a 6 month roughly gives you 2.75, 9 months at 2.8, 1 year at 2.95 as we previously showed, and we can keep on going all the way through to say 5 years. Now obviously depending on the market, the types of investment, this maturity profile could keep on going forever, but for the sake of this example, let's limit this to a term deposit between 3 months through 5 years. And we can see that we have this table of returns for the various maturities. Now the question is, can we convert this tabular format into a different type of format, say a bar chart? So what we can do is take the maturity profile of the term deposits and lay it out horizontally across the x-axis. So we can have the 3 month through to 5 years at the bottom. Now, we take the returns and we plot them against these various maturities. And we can see that from a tabular format, we can convert this into some sort of bar chart where we can immediately see that the lower time frame will give you a lower return, and the further out that an investor goes, it should theoretically give you a higher return. So we can see that, say, a 6 month is at 2.75%, a 1 year is at 2.95%, and a 4 year is at 3.05%. In other words, you can graph this using a bar chart, and it gives you the same information. Now, what if we connect these bar charts with a line? And that's effectively what the orange line is right here, and that is the term deposit yield curve that we have. In this instance, this orange line is a positive yield curve. And the reason it's called a positive yield curve is that we can see that the longer the investor invests in, the higher the return generally that the investor would expect. And this is how a yield curve would normally perform, right? So the longer you keep a term deposit, you're locking it away. You don't want the bank to keep it for free. You want a higher return because you're not using the money for that long. But now let's say the market moves for whatever reason. There's a number of different factors that play behind the scenes. But for some reason, these interest rates keep on fluctuating on a weekly basis, say. And now, a few years later, you look at the yield curve, and all of a sudden, the bar chart has moved. And now you can see that for some reason, the shorter time frames, like 3 month and 6 month, give you a higher return. And in fact, the longer you go, especially towards the 4 year and 5 year, you can see that the returns are dropping. Now, if you repeat the same exercise that we did before with the line, let's draw a line here. We get this red line, which would be the new yield curve at this specific point in time. And let's compare these two. So you get this red line compared to the dotted orange line that we had before. But you can see in this red line that the longer the time frame, the lower the return. And this is something unique. It doesn't happen often. And in fact, this is what is known as an inverted yield curve. Effectively, what it's saying is the market will reward you for keeping your money in the short term. But if you lock it down for the longer term, they'll in fact give you a lower return. Now, the question is, why does this happen? So let's first of all look at what represents the inverted yield curve. Generally speaking, the market will look at two specific points. So let's extend this chart a bit. And instead of 5 years, we will say we'll go out all the way through to 10 years, right? So we draw these two lines. We've got one at the 2 year space and we got one at the 10-year space. And this is called the 2's 10's curve. If the 10-year rate is lower than the 2-year rate, so which means if you lock something in for 10 years and you're getting a lower return than locking something in for 2-year return, that is an inverted yield curve. And the signal that it sends through is that's a recession coming up. And to understand this as to why it signals such an indicator is because what it's trying to say is investors are worried about what's going to happen in the long term. So what they're saying is, you know what, it doesn't matter, Yash. I don't care if you're just giving me 3% for 10 years. I know that the economic indicators don't look good. I know that the economy isn't looking that great. I would rather get a guaranteed return, close to guaranteed return of 3% and keep it locked for 10 years instead of trying to game the market, lock it in for 2 years and see what happens in 2 years' time when the term deposit matures and I get my cash back. So the more the investors that jump onto this mindset and they jump onto this 10-year locking mindset, what's going to happen is more investors are locking in. The banks see that there's more demand for this, so all they need to do is lower the interest rate for the 10-year space because there's more demand. No matter what the interest rate is, even if it keeps on going lower, there will be investors looking to pile up into the 10-year space until it reaches an equilibrium. So at some point, you will see that the 10-year will slowly start going below the 2 years, and at that point, the market will start freaking out because they see this as an indicator for a recession coming up. So the question is, has this happened in the past? And in fact, the answer, yes, it has. So this is pulled off the Federal Reserve Bank of St. Louis. And you can see that, first of all, it's a pretty complex looking graph, but if you look at the baseline, the black line in between, that's your zero line, and that is effectively saying this is the difference between your 10-year and 2-year rates. If they both are equal, the difference will be zero. If the 10-year is higher, your difference will be positive. And if your 10-year is lower, then your difference will be negative. So effectively what we're saying is anything that's above the black line, that's a positive yield curve, things are double quote normal. But if it's below the black line, that's where you have an inverted yield curve. And you can see you have these gray bars popping in vertically from time to time. And that's effectively the recession. You can see, in fact, some of these recessions right here, where the latest one being the GFC and the 2009 global financial crisis. And this is the interesting part. You can see this preceded at the base of the red arrow by an inverted yield curve. So the idea is that whenever there is an inverted yield curve, it's not an immediate recession, but generally within a year or a couple of years, there will be some sort of recession hitting the economy. And the problem is, recently, what's happened is you can see right towards the very tail end of this graph, and let's zoom in a bit. This graph has been coming in lower and lower until all of a sudden it's gone just below the black line. And now you can see that technically speaking, it has gotten inverted for a few days. In fact, I think it was for a week. So what the investors are panicking about is that theoretically, this signals, as you saw in the previous picture, an upcoming recession in the next couple of years or so. Now, some people say this time's different. We've all heard that before. And some people say, well, we've seen this happen every single time in the past, so who's to say that this time it won't be different? But the idea isn't to say yes or no for certain whether there's going to be a recession, but it's to understand the key drivers behind why there is a yield curve, why a yield curve inverts, and what the logic is behind the scenes in terms of why that could potentially signal an upcoming recession. And mainly it's because investors are panicking in advance and locking the money, in that example, for 10 years in advance. So we've covered that. Now the question is, okay, we've covered just the term deposits in this presentation, but are there other sort of yield curve? Absolutely. Generally speaking, you don't really use a yield curve for a term deposit. It works. And like I said, a yield curve is nothing other than a bar chart that tells you what the interest rate is for different maturities. But generally speaking, you will have a yield curve for your government bonds, where your government issues a bond, they're looking to borrow some money. And again, if they issue something for 3 months, they want, or you as an investor will want a lower return. But if they issue something for 5 years, you'll want a higher return, even if it's the government, right? But then let's say we'll take it a step higher. We could have a corporate bonds curve. And this is effectively saying, again, in New Zealand, it could be the likes of ANZ, BNZ, your banks, Fonterra, the likes of these companies issuing bonds and borrowing money, but you would want a slightly higher return because they're not as safe, I guess, as the New Zealand government. And for those of you overseas, it could also be the same where McDonald's, say, is borrowing compared to the US Treasury. And in this case, it's represented by the yellow line. And the difference between these two will be the credit spread. And credit spreads can vary between different maturities. So you can see that the credit spread in roughly the 9-month space is lower than the credit spread in the 5-year space. So effectively what you're saying is the higher the credit spread, the higher return you'd expect for that corporate bond in that yield curve. And again, you can use this yield curve for almost anything. We can also plot one of these yield curves for junk bonds. And as you would expect, the credit spread will be higher. Junk bonds are less safer, or in fact, if anything, you'd say they're a lot more riskier, and it would suit someone with an aggressive profile, but you would expect the return that an investor would demand, even for a 3-month rate, to be pretty high. And in this example, you can roughly see that the return that an investor is requiring for a 3-month junk bond is in fact higher, or if not roughly the same as what an investor would want from a 5-year government bond. So that gives you an example of what a yield curve is, how you can use it for different types of instruments. And whenever you see a yield curve come up in the news article next time, you know what they're talking about. Thanks, everyone. If you have any questions from this presentation, feel free to post it in the comments. And if you'd like to hear more about a certain topic, again, feel free to post it in the comments, and I'll try to address them whenever I get a chance. Thanks.